in terms of signals, I like to look at, there's three, and you always want to look at the price signal that a security is giving you, the fundamental, or we can call the earnings or free cash flow signal a security a business is giving you, and then the valuation signal that it's giving you.
Welcome to the Breadth of Experience podcast and part 2 of our first quarter stock market review. If you missed part 1, don't worry, you can still jump in as we continue unpacking the biggest market themes of the year so far. In this episode, we'll dive into what stage of the market we're in, Trump, tariffs, policy, and how we forecast for uncertainty in lieu of this. Let's get started.
Interesting in the markets too, especially with the increasing prevalence of pod shop in a lot of trading. It seems also when some of these unwinds happen, the liquidity moves is pretty fast and vicious, kind of like the Japan yen carry trade last year, and even with this, with the crowding. So that was a bit of a blip at some point. It was fairly quick. With this, it feels a bit more extended. So to your point, where do you think, we're still reverberating, but from an innings perspective, where do you think we are with this? Or kind of like mid-stage, market is still digesting. We've had a month and a half now to pass that. What's your view here?
Yeah, I don't know if I'm smart enough to know that. I'm a take it one day, one shot at a time type of person. So, if it's the third inning or seventh inning, like, I don't know. We'll see. As like for me, I'm always like, it's okay. I don't need to. There are enough people that are time travelers. Like I'm happy living in the present. So I'll let other people decide what inning. I think what I would say is that this is not happening in isolation. So like I said, I think people are readjusting their exposures and what they think are winners in the data center, and at the same time trying to deal with the uncertainty from the policies in terms of what are we tariffing and what is the ultimate goal of the tariffs, and at some point when does this all sort of stop and we move on to the next thing. So I'd say tariffs are the thing now. And, that is the thing that people are most focused about. I think some people even forgot about the data center. So
that's a pretty interesting.
So
I
that's
like that
thing.
take.
I mean, I'm curious to see what Vitali thinks in terms of innings, but
Vitali, yeah.
For me, I'm always like, I'll let other people travel forward or backwards. I'm happy to just be in the present.
I do like being a time traveler. Exciting proposition. In the context of baseball, I do think we should have brought Damien back then, and he's our
he's. I know what innings he called.
Innings. Yeah. It's important at these junctures not to call innings, but I think just to get a lay of the land, and in terms of signals, I like to look at what are there's three, and you always want to look at the price signal that a security is giving you, the fundamental, or we can call the earnings or free cash flow signal a security a business is giving you, and then the valuation signal that it's giving you. And if you look and they pick a security that has been caught up in this data center thematic and sell off now, you could look at some, and I won't name names, just talk generically, and you could say that price signals were very strong. You could make the argument that at a certain point they became extended relative to the fundamental earnings signal that presented. That probably drags a valuation signal to the upper end of that spectrum as well. None of those in isolation are going to tell you whether to buy or sell a stock. But I think as you revisit and recalibrate to new market conditions and new information, you can at least begin to get a sense of, well, hold on, has the adjustment in the price has it anticipated a decline in earnings? And that's a very difficult question. But for a team of analysts, it is also, I think, a key requirement of the job to try to forecast the future and anticipate it.
Be a little bit of a time
taking in this
traveler,
information, trying to say, okay, there's been a price signal that's been reset or that's inflected in a different direction. Do we anticipate and forecast a change in the fundamental, the earnings signal? Of course, that informs to match that. And then where are we today from a valuation signal, which can be measured with various different techniques. But these things together will not allow you to come into the office on a Monday and press buy or sell on a security and get the call correct for the next day or week or month or whatnot. But they, if applied systematically, can give you a toolkit that lets you have a conversation with Ben or Damien or another PM and help us make probabilistically better bets.
So I like that. Rather than thinking about where we're in the inning, your framework is simple. It's like, what is the price? What is the price telling me now? Is there a certain value in that stock at this given time, at any given time, right? Rather than thinking in that sense.
And sometimes there's a lot of value, and sometimes, to take an extreme example, there just may be no buyers for something, right? And so you have to be pragmatic. And if you have you could have whatever it is, an antique treasure from the Roman Empire. That's a kilo of solid gold. But if you're on Mars with no
No
one
buyers.
values, with no buyers, then it's worth zero. And so you can't go to your PM and say, well, this is the deal of the century. You have to make this your biggest position in the portfolio. That's not astute analysis, right? So we want to be careful not to overweigh any single factor, but have a mosaic or formula or whatever it is.
I love that. And with that was a perfect segue to the next section, which is, it seems the market may have first reacted to DeepSeek, but now, as Ben said, shifted its focus entirely to some sort of policy uncertainty. And I think Trump apparently relegated tariffs to his fourth most favorite word, after God, something else, and something else. So we don't know. It keeps changing. But it started out, I guess, at first with the post his presidency, the way the markets were going. In some sense, it seemed like they were calling his bluff that this is purely a negotiating tool or whatnot. But something has changed with how people view the tariffs. At least, what is that in your view, Ben? Like, what do you think? And your opinion of, at least, what's your take here? Just the word tariffs and whatever this policy uncertainty is.
From my perspective, again, if we could see that the market could pick up, there's a high probability that Trump would be president as early as 2023. Which, when I say that to people, I always get like a raised eyebrow. But, there are some charts that again, they don't tell us the exact answer, but they were starting to lean into a certain direction, and they continue in that direction. Then I would have to then say that how could the market then not also factor in tariffs? So for the longest time, or for the last couple of months, I've been trying to figure out, has that changed? Or is there something new? Because, again, I'm always happy to hear the other side. And the other side has been sort of, the market's being very complacent. It's a negotiating tool and it doesn't really mean anything. And so early on, we did see sort of tariffs were on, tariffs were off, kick down the road. I think the other thing, where we stand right now is that the rationale and the reasoning for the tariffs we're well far away from where we started. And everyone has a different take on what it's for. And I think that's the part that's confusing. So now it just feels like it's tariff for tariff's sake because, everyone apparently has been ripping off the US. The areas that I have been really focused on has been in the financial sectors. So we'll see if that's the right area to focus on or not. But to me, they're sort of the transmission mechanism for all things economic activity. And so in particular, really focused on Canada because when it comes to negotiating, there's not much we can do. I mean, we have chosen the US as sort of our biggest trading partner. We have forsaken other sort of policy decisions that we could have done over many years to try to diversify or make investments in productivity, but we have chosen not to. And so there's so much talk and chatter and fear about what these policies could do to Canadian businesses. That's another thing I want people to I've had to be more sensitive to. This podcast is just talking about securities and investments. And then there's also the real world.
Real world, yeah.
Where people have businesses and maybe they're in the business of copper, and adding all these tariffs destroys their business and livelihood. And so I could say, I don't think tariffs matter. I just want to make sure it's in the context of stocks and investing. Whereas whether or not, if these tariffs remain in place, could have real world implications for certain businesses. So I just want to be keenly sensitive on that. I would imagine that, again, at this juncture, if tariffs are going to go through and like literally obliterate our auto sector or our entire economy, it's just not showing up. That fear is still not showing up into the Canadian banks.
Price rise, right? Yeah.
Price-wise.
Yeah, it doesn't seem. And I will open up the question to Vitali. Is it simply a question of like, what are your analysts telling you with the conversations with the auto industry? Is it a question of like some of these wildest fears are just so impractical? Like think about a car that's transshipped 7 times between Windsor and Detroit. Where do you apply the tariffs? Like which midpoint, like how many times are you going to do it? Like so is it because of that, like the market doesn't even know what the tariff is? If it's going to change tomorrow, how do you even forecast? Like what are your analysts telling you?
Yeah, I think we just had actually our autos analyst in Detroit on an auto tour, meeting with major American automakers and suppliers. And obviously we're a very important part of the auto supply chain for North America, having a global tier 1 supplier as well. But I think you captured it you captured it well in that there's a little bit of disbelief, which can be dangerous because there's something is happening and nobody believes it. That can cause securities prices to re-rate. But there is this perception, the feedback was that, at least on the American side, that adjustments can be made and negotiations will succeed. Our perspectives also are very different, right? Because it's always stark, I think. I haven't been to the US this year yet, but the analysts that have been down there, what's stark is a bit of shock from them where they go in there thinking, well, this is an existential issue because we're Canadian, and it is to some degree, as Ben was describing. And then from the American perspective, it's like, it's a big, powerful empire, and many of them can't locate Canada on the map. So it's like, hey, it's going to be fine. What are you guys so worried about? But I think, this goes back to, we've lived through something with COVID that was different, but, it rhymed to some degree. And what rhymed is it was a great degree of change. And as we talk and look at picking securities that and go into Ben's portfolios plural, adaptability is a word we need to bring back and really emphasize again, because there's the Main Street, and Main Street has a collection of companies, some resilient with good capital allocators and great products and good industry structure, and some not so much. And in the public markets, I think we can sometimes forget that even though these are all large companies that have succeeded to a great degree to find themselves in a position where we would look at investing in them. So not adaptability, but rather differentiation can be a little less visible to an analyst, especially if you think of an analyst earlier in their career. All these companies do a great job of putting together beautiful presentation decks, and they've got polished management teams and generally financials that they can at least massage a little bit, right? And so our job now is really get down to the brass tacks and say, you know what, we are going through a period of change again. We're not going to speculate what innings it's in. It's a fun intellectual discussion, and we do engage in it as a team. But ultimately figuring out, okay, but which industries and companies do we think have underappreciated free cash flow, participation in secular themes? Because you and I talked about this kind of like the era of lights and shadows here, right? You've got government efficiency with Doge, and at the same time you've got potentially layoffs of real people with real children and real families and real obligations. You've got a potential for peace to what seemed like a never-ending conflict in Ukraine. And that's a good thing. And at the same time, you have a fragmentation of historical alliances. And so there's all these contradictions. But, to investors, what I think for me and Ben and the entire analyst team, it does make the job more exciting, even because for everything that's not succeeding now, we can use our brains and find new themes and new parts of the market that are working, and we can get ahead of that, because just as the data center theme could be around for another decade, but what I think we have to acknowledge is the reason these portfolios have been successful. One of them is the great work of the team and the portfolio manager in identifying it early, right? But what's next? Where's the work being done? So this is all tying in a lot of themes, but...
No, I love it. I think, Ben, actually, you accidentally captured it perfectly. It's such a blender market.
I accidentally, maybe.
Maybe intentionally.
Do a blender sound effect. Can we do a blender sound effect?
We should do a
Let's
blender.
Do that at the beginning. That's like the trademark of the show.
Yes,
yeah.
It's a contradiction market, right? Because there's like stuff that should theoretically bring down the risk premium, like a war ending, globally. But also at the same time, alliances fading. So which one do you choose? Same with the government, right? Government efficiency, deregulation, great. But uncertainty and chaos, not great. Which way does the ball kind of fall, right? So to that extent, I will pull a little deeper on the U.S., especially with all of these government actions with Doge and whatnot. First off, what is the long-term view in that sense? Where is this a structural change in the way the U.S. government funds itself or sets up the U.S. government? And two, what are the short-term implications of this, let's say, slightly chaotic or approach, or at least where the messaging is very chaotic in how they're doing this?
I'd say when I joined this industry and I joined TD Asset Management, so this is going back to 2009, the big thing that people were focused on were the entitlements and the growing, so this is like Social Security, Medicare, and how it wouldn't be very long. Again, I'm talking about in 2009, and last time I checked is 2025, but it wouldn't be long that this would be something that could bankrupt
It'll be insolvent.
the United States government. And then I think also it wasn't too long after that where the US had lost its credit rating. And then we had talked about how like Microsoft and Johnson & Johnson had better credit rating than the US government. How can this be? That's not how we wrote the textbooks. And so this is, so there's two things. This is where Joseph and I, you and I like to talk about being right and making money. And so, you could say, let's short the US because they have these entitlement issues. You'd be very wrong that trade. This is something that we're getting closer and closer to where this becomes a bigger issue. And I'd say, again, I don't know if this is the ultimate aim of this administration, but they're sort of saying like, yeah, we're going to go and try to attack this because this is the biggest existential crisis that we're dealing with. The cuts that we're seeing right now, again, I don't know if that's a bit of political theater. Like, look at what we're doing, but did they actually do anything? The only thing that I could say, I guess, again, I don't know if anyone actually wants to tackle these because in the long run, I don't know. Well, and maybe this is the president to do that because he's not looking for re-election. Because if you are trying to attack, entitlements, that's not going to, no, most people will probably be like, yeah, we have to deal with our debt, but you're not cutting my social security checks and my Medicare because that's what I've been working my entire life for. So we'll see if that's really the ultimate aim. I get the sense right now we want to extend the tax cuts. We might want to put more tax cuts. And the sense that I'm getting is that they're short on cash.
Elaborate. Let's elaborate.
This would be too cute. And again, I'm just floating it out there. I think they all recognize that coming out of COVID, governments have a lot of debt. And in particular, a lot of long-term debt. And what I have noticed is that Trump has been particularly silent about the Federal Reserve and Chairman Powell's short-term policy agenda. And I don't know, again, too cute. Markets never work this way. But could you use the tariffs as a way to bring people's expectations on growth? Also, in such a way that you don't destroy the economy, that you can bring it back for midterms. And that is a way, an attempt to lower the interest rates. And we have seen the 10-year and the 5-year come down. Again, not crazy, but it has come down. So, all right, you have interest expenses sort of crowding out the budget. And maybe, again, if you can show people, look at how much we've cut, the billions and billions, then maybe you could engineer some more, let's say, tax cuts in the coming budget or our next two budgets. And that's a way to sort of push the agenda. So I don't know. I'm floating it out there. I'm happy for everyone to take it down and laugh at it. I can't imagine that anyone could be, people always talk about there is someone out there, pulling the strings, and there's that, secret societies and all that type of stuff. Like, I don't know if anyone can actually pull this one off, but so far rates are lower and people's expectations are getting more concerned. And it's definitely bearish. Like the temperature is really bearish right now. But the fear is you do it so much that you actually have a self-induced recession. And one that's not easy to fix itself.
I subscribe to your conspiracy, and
it makes sense.
No, it makes sense. I'm not saying in a negative source. I'm like, the only difference between a theory and conspiracies are sometimes true, right? So, so it's like this could be very well true.
No, this is something that the Treasury Secretary Scott Bessent too in his talks has been saying about the funding issue of relying on that short-term T-bill issuance nonstop, and how they have $10 trillion of funding that they have to do this year, right? And obviously, it's better if you term it out at lower cost.
Thanks for listening to the Breadth of Experience podcast in the second part of a first quarter breakdown of the stock market, with part 3 coming shortly. If you enjoyed this episode and want to listen to part 1, be sure to follow us on your favorite podcast platform, and now on YouTube too. Share it with friends and colleagues who love staying informed. A big thank you to our team behind the scenes, Marko Vidovic for producing the podcast, Bianca Sampson for keeping the conversation going online, George Subotic for making sure the podcast reaches you, and Alina Zrasko for crafting the copy that brings it all together. The views and opinions contained herein are those of the participants and do not necessarily reflect the opinions of and are not specifically endorsed by TD Asset Management Inc. or its affiliates. This is for information purposes only and should not be construed as financial, legal, tax, or investment advice. It is not an offer to buy or sell or an endorsement, recommendation, or sponsorship of any entity or security discussed. Commissions, trailing commissions, management fees, and expenses all may be associated with fund investments. Please read the fund facts and prospectus, which contain detailed investment information before investing. Funds are not guaranteed or insured. Their values change frequently and past performance may not be repeated.